Welcome to the Proactive Podcast, brought to you by Me Media.
G'day world, Chris Hogan coming to you from Me Media Studio here at Burleigh Heads for episode 122 of the Proactive Podcast. And I have with me today Jason Atkins, co-founder and CEO of Cake Equity. How are you, Jason?
G'day, mate. Good to be here.
Mate, great to have you finally in the studio. It feels like it's been a long time between chats, especially on camera for us.
Yeah.
So, mate, Cake Equity, could you give us a bit of an overview as to what Cake Equity does?
Yeah. So I guess if you're a startup founder, it's really easy to understand what Cake Equity does because you probably run a capital raise or you want to raise capital and it is like a total nightmare. So we streamline and simplify the capital raising process is probably the easiest way to describe what Cake does. If you're not in startup land, I think it probably just sounds like a whole bunch of, strange and foreign.
Let's educate
stuff,
them. Let's educate them, mate. Yeah.
So when you want to raise capital, you first need to work out like how much you want to raise and how are you going to value your company, and then are you going to sell equity, or are you going to do a convertible note or a safe, and like every single part of that is normally totally foreign to the person who's got to do it.
So there were three things you just said that people would just be like, what?
They're all
equity,
mind-blowing.
safe, convertible note.
Exactly.
What?
And
So
then when you look at it, like each thing has this whole big pile of stuff that people just don't want to deal with at all.
Right.
But you have to.
Yeah.
Because it's really important. If you get it wrong, then down the track you come across some professional investor. So one of the worst things that'll happen, so I'm a founder, I want to raise, say, $500,000. And I go out to some angel people that I find, and they give you this
Angel
rubbish
investor
deal, right?
People don't necessarily understand an angel investor either. Well, put simply, it's just an investor, right?
An investor who invests in really early stage companies. So the first two lots of funding that a venture will get when they're getting off the ground.
Hence, they're an angel. They've got a heart of gold, and they expect that you're going to do amazing things.
Exactly, and they're really, it's like, I don't mean to say this too flippantly, but it's like part donation, part investment. Like it honestly is, because the investor has no idea if you're going to be successful or not. And they try and do the best they can when they're investing, but the variables are infinite. So, that's why I guess they're called angels. So those first two rounds are really, really tricky. Normally the founders know nothing, as you say. They don't even know what a convertible note is. They don't know how to sell. They don't know how to do a pitch deck. They don't know how to do anything.
All right, so
normally in the beginning.
A founder needs money.
But they need money, definitely.
They need money.
Just say you want to do a software company. What's the minimum amount, you can spend on a decent piece of software?
Minimum 250 grand.
Exactly. And I think we're up 7 figures now
Yeah.
at Cake, which I would never have believed
Yeah.
if anybody had told me that. I remember back in my CFO days, I'd be working for organizations as a CFO, and we'd get these software quotes to build stuff, and they'd be like 300, 400, 500 grand, and I used to just like, no way. But now I know how crazy hard it is to build software.
Now you've spent it.
Now I'm spending it, and it's hurting. It hurts. But so to do SaaS, which is like such a great place to be, because if you can do it well, the upsides are tremendous. We've all seen that.
Infinite growth, right?
Infinite
Possibility.
Growth, 95% gross margin, 50% net margin businesses with, 20-year time horizons. It's the ultimate business nearly. Especially if you're doing good in the world, I should say, because, that's what we're all really here for, right?
100%, mate, 100%.
So, so you need 250 grand. Not that many people have that, and so you got to go out and find people that trust you, that will back you. They're normally called angels.
Great.
So
we got to value the business.
So you got to value it first.
So how do we value a business? Is there a trick to that? Is it annual revenue?
Like the technical way to do it is like a discounted cash flow, to a net present value, which is more or less impossible. because you don't have any cash
flow.
flow. Well, you don't have any product or any customers or anything.
Right. What you do have is a pitch deck.
Yeah.
And maybe
and
an
dream. And a dream.
And a dream.
You might have an MVP. You should probably have at least some sort of MVP when you're raising money.
Which could just be a prototype slidey app thing or...
Yeah, some sort of proof of concept.
Or,
you need the minimum. I mean, you got to convince people to give you money, right? So
right.
you need to learn.
The biggest thing that people do need to do is they need to articulate what problem they're solving, right?
Yeah, it's normally the team and the problem and the solution and the deal.
Yeah,
sort of the most important things in the beginning, because everything else is an assumption.
And I think Bill Reichert, he harps on the problem and that you have the solution. So he's very big on that. And also the founder, they're nearly always investing in the founder or founders.
Yep.
Because they need to know if you've got the get up and go or the drive.
Totally agree.
Yeah.
I totally agree. You look at Blackbird Airtree, top venture capital, in Australia, which is the next stage if you're successful. It's all about the people and the mission, and where they're going. That's what people back. That's what investors back. I've looked at 500 startups and Guy Kawasaki, and there's a great matrix out there that sort of says, what do these people look at? Yeah, problem, solution, team, and then the deal. And what startups quite often get bogged down in is the deal. They don't know how to do it, and it can take months, and it can cost them 10, 20 grand, and then even after they've done all that, they can have done everything wrong. And I don't mean to hassle the lawyers and accountants involved, but they may not even be experienced at startup deals, and people quite often get bogged down in this stuff. And then they go to an angel group, and angel groups unfortunately lead them astray. The angel community in Australia is relatively new and isn't as sophisticated as other developed economies. And so, we need to educate the angel investors as well to understand what it really means and what the deal needs to be for it to be balanced between the founder and the investor. Quite often you see founders getting bogged down doing lots of, special terms in these early deals that constrain them significantly and then cause them trouble when they need to do the next round. So what Cake does is provide very simple contracts inside the software to do all these early deals. So if you wanted to, you can log in. If you're a founder, it's probably one shareholder in the beginning, and then you can click a few buttons and you can be raising capital the very next day. The contracts are built in, DocuSign's built in. You can have it integrated with your registered agent, so ASIC's integrated, so you haven't got to worry about, is my cap table in sync with ASIC and all those sorts of dumb things that, again, founders really need to get right but don't know how to deal with or want to deal with it, right? So we've combined like 6 or 7 steps all in a row in the one piece of software, so the investors log in, your accountant and your lawyer can be logged in, the directors are logged in, and everybody's working in the one place, so that the capital raise is just a hell of a lot easier for the founders. We also do a lot of education. Education's a big thing. Founders need to learn a lot very, very, very quickly, and there wasn't, in our opinion, a lot of great information out there around all these matters. So we write about capital raising, we write about convertible notes. Should I get into employee share schemes?
Mate, no, let's take a backward step. The valuation of the company, and you use some technical terms there as well. So is there a simple, a really simple way to understand what the value of your company is?
Yeah, so...
Is it annual turnover? Is it
Depends
net
on the
profit?
stage. So it depends on the stage. So right in the beginning, before you have any sort of consistent revenue, you can really only use, in my opinion, it's called the Berkus method. It sounds very nerdy.
Yep.
But it's essentially, there's 5 factors. You give yourself a score out of between 1 and 10 for each factor, and then you get a value of between 0 and 500K for each factor. So your company will be worth somewhere between 0 and 2.5 million, depending on where you rate yourself on these 5 factors. And I'm pretty sure it's the size of the market, how far along your MVP is, how good the team is, a couple of other things. It's very practical, it's very easy, and you can talk to the investor about it. You say, well, I give myself a 7 and an 8 and a 6 and a 4 and a 3, and therefore I valued my company at 1.75 million.
Great.
That's honestly the best way I've seen to value a very, very early stage company.
That's fantastic. Thank you. So that was called the
Berkus method, Berkus, if anybody wants to Google that.
Beautiful.
There's also a piece of software out these days called Equidam, Equidam, and they're trying to use big data and a qualitative and quantitative method to create a reasonably sophisticated early stage valuation very, very quickly. Only costs about $300 or $400 US to get a subscription, and they've got a similar style. They do 5 different types of valuation, and then you can weight which ones you want to focus on. So if you're a later stage company, you might use a discounted cash flow method or a revenue multiple method. So these are the more common methods when you go to venture capital. So like I've got to 1 million ARR. Companies in my industry are doing annual recurring revenue. Yep. So my company's now doing, say, 100K a month in recurring revenue, right? Which is every early stage SaaS's dream, a sort of product market fit, right? So you've got there, and then you look around your industry and you say, well, this is when you start to get into those big revenue multiple valuations. If you're doing really well and you've got a big market and your product's working quite well, you can get 5, 10, 20 times revenue valuation once you get there. So obviously a wonderful situation for both the founders and their investors.
So I don't get why those valuations exist. Yeah. Like 20 times revenue, like shouldn't it just be revenue? That's your value?
Yeah, I guess it all comes down to, if I put like $10 in today, how many dollars am I likely to get out of this company, in the future? And with, say, an accounting firm, normally, it'll be 1 times revenue, because you might be growing at a few % per year, and you kind of know accounting firms run on, say, 30% net margin or whatever, right? There's a nice way to value that. But with software companies, they can double every year. Sometimes they do 3-4 times revenue growth in 1 year, and they may have no competition in front of them and a huge market, and they may be running on a 60% net margin. So these are very, very powerful financial drivers that compound year after year after year, and that's why investors are happy to take these big revenue multiples, because the value creation is tremendous from these companies when they really get it right. Now, of course, you need to have a lot going for you to get that type of val, but I do a lot of investment analysis as well as like a side project, and the proof's in the pudding. If a company goes from 10 million to 100 million to $1 billion valuation, then why would you not invest? It sort of seems hard for people to understand.
No, that makes sense. But how many actually go to $1 billion valuation?
No, not many at all. Not many at all. Yeah. So, but like from a portfolio perspective, so most portfolios will have, say, 20 holdings, maybe 30 holdings, and the way an investor looks at your company, every single investment they make needs to return their whole portfolio, and that they won't make that investment otherwise. So if you want a 10x valuation, you have to show that you can go up 100 times.
Yeah.
If the investor doesn't look at you and see there's a possibility that you can go up 100 times, then you can't get that val. And they'll try and have 20 of those in their portfolio in the hope that one of them will go up 100 times, and 6 out of 10 will go nowhere.
Yeah.
So it's funny for most people to sort of get their head around this stuff. It's funny for me to get my head around it, and I'm sort of doing it regularly.
Yeah. So what's Uber and WeWork done to, I guess this investment market? Have they totally ruined it for everyone by basically, not making revenue, not making profit, just exploded in valuations?
Yeah, I think it's a good thing that they've exploded, as in like imploded. It's great when these companies implode, because it highlights the risk. I think one of the worst things about early stage investing is when people do it without an understanding of the risk. They're not very good at maths. They don't understand portfolio theory. They're not investing with the right people at the right time for the right reasons. That's much worse than companies imploding. One of the worst sort of things that can happen is that, say venture dumps a company on the public market and then they implode. Nobody really wants to see that. I don't think the venture industry really want to see that either, because it makes their life more difficult, but it is certainly a balance that always needs to be in check. And these implosions do that because you have a couple of really big ones. Everybody talks about it, and all the valuations across the venture space should, in theory, then drop a bit, and there should be some more DD going on. But also we need to be aware that quantitative easing has been occurring now for quite some time, and there's a huge amount of capital around globally that needs to be deployed. So that's just a fact of the modern markets. So it's tricky to allocate capital, and we see that in the US much more so than Australia. There's a huge amount of capital that needs to get allocated, and so whether or not that's being properly allocated is not something that I'm able to properly articulate, but it does create a bit of a question mark, I suppose, for individual investors when they're trying to find a return and they know that there's this huge wall of capital out there, and trying to get that balance right is definitely something that the industry's grappling with.
Yeah, okay. That's great. So Cake Equity, it is a software platform. It's a SaaS platform, so software as a service.
Yep. That
founders, investors, accountants can all log into to see how the business is tracking on its valuation. It also does. You can obviously distribute shares.
Yep.
And it's used to distribute shares to employees as well, right?
Yeah. Yeah, I think employee shares is a concept that was really popular in Australia like in the 80s, and then it got really hard. And in 2015, there was a really awesome scheme put in place to allow startups particularly to give their employees shares without causing any tax dramas. And it's fantastic. We love it. Startups are not easy, and they are built largely on the effort and creativity of their teams. And so, most startups in Australia have 10-15% of their equity held by their teams, which is awesome, because then if and when they're very successful, the teams can really have a life-changing financial event, something that we're super pumped about at Cake.
Cool. And so how long do they generally hold those shares for? That's for whether they're employed or not, right?
Yeah, it depends. It depends. The company and normally puts those rules into the scheme in the beginning. So you sort of have to design the scheme, with good leaver and bad leaver provisions. So normally if a employee gets fired or, does something bad, the company needs to protect itself. And so they'll normally take those shares back at a pretty big discount, or, potentially just nab them back, because that's not a good outcome. And then, but normally if someone's a good leaver, then they can hang on to their shares. And what the employee really wants is like a dividend, or if they just say Canva now. Canva's worth 6 billion or 8 billion or something like that now, after quite a few rounds, and they're a global SaaS juggernaut.
Are they profitable?
I haven't seen their deck. They're a private company, but I'd be surprised if they're profitable. And this goes into, I guess we can talk a little bit about the economics of a SaaS company, if you like, because I think a lot of cash is king's a prominent thing, I think, especially on the Gold Coast and Queensland, and most people here would be much more familiar with cash flow businesses, and understanding the economics of how a loss-making business can be worth so much is super baffling.
Mate,
I've spent my life
drives me
in
nuts.
finance, so I have a pretty clear understanding of why, although I need to be careful not to drink the Kool-Aid of the bloody, the unicorn brigade sometimes. But they're probably not making money. They would be investing all their profit in growth, would be my guess.
Which is, mate, that's the regular story. That's the usual story. Yes, no, we're not making profit. We're investing in growth. Yeah, heard that one too.
Yeah, it doesn't always work for sure, and I think it's a double-edged sword with venture capital sometimes.
What sort of timeframes are they sort of working on mostly? Like, are people working on 10, 20 year?
I think it's about a 5 to 7 year sort of time horizon normally for a venture capital firm.
Right.
So they'll look to get the maximum number of customers or market share in that time frame, and then be looking for an exit. That's sort of a pretty standard sort of time frame. And so, as a startup founder, you've got the option of going for venture capital or looking for some more patient growth capital, or bootstrapping, or, and then there's like little combinations of all those things. But venture capital is normally like extreme ultra growth at all cost, invest all money at all times and raise more money and spend all that money constantly to get the most market share you can. And then the principle is that at some point in time when the growth is not there, you flip the company back into an operating model, and you should be always tracking your operating margins versus your investment, your growth investment. We do that at Cake, so we kind of know what we operate on and then what we're investing into growth. And then if you can see your operating margin is, with SaaS companies could be as high as 60. I've even seen them run on 80% net margin. If you can see your operating model's 80% net margin, and you can be growing customers at 300-400% per annum, or some of them grow at like 10-20x per annum customer growth with an 60% operating margin, like it's very alluring to go after that market share, knowing that once you flip into operating, you'll be throwing cash out like crazy, but it's very high risk, very high return, which is why there's so many failures and why the model can have a bad name, because it's super hard to get right.
Yeah.
And there's so many variables, but I'm still learning all this stuff, and at Cake we need to learn and we need to make these decisions ourselves. We're sort of, we did some funding. We've done 2 rounds of funding, and we're sort of gearing up for our 2021 growth and strategy and all that, and just trying to assess, which funding path we go down, and how we grow, and all those sorts of things. And I can tell you from inside a growing company, it is extremely hard to do all the stuff you got to do. So hats off to the ones that get it done.
So let's just take a step back to getting funding. So you said that Cake can help you organize all of your numbers and et cetera, and the paperwork in order to get funding. Does Cake help you actually pitch for funding as well?
Yes and no. So our core business is definitely just making it all happen.
Sorry, making what all happen?
Well, yeah, okay. So let's use a use case, right? So I'm a founder. My name's Joe, and I'm raising capital. Typical method to raise capital will be investor readiness is the first phase. So how much am I going to raise? We talked a bit about Val. I've got to get my pitch deck ready. Most founders can sort of get all that done. Then they've got to go and have all their meetings. So you go and have all those meetings with investors, and off the back of that meeting, there's normally some follow-up questions, and then they'll want to know what the actual offer is, so the sign-up documents. That's where Cake kicks in, and there's normally, somewhere between, just say there's 10 investors in a round, you're looking at 100 different emails, and 4 or 5 different data points for every investor, and it's just an absolute nightmare. I've done it myself. One time I had to issue just 3 convertible notes, and I sat up on like a Sunday night, and it took me 2 hours to put the information into the document, and then put the thing into DocuSign, and then put all the data in the thing, and then check it, because you can't get it wrong. Like, you send an investor document with their name wrong or the amount wrong or anything wrong, and it's a big red flag.
What's a convertible note?
So convertible note is like, It's a very common way to raise capital in the beginning, especially when your valuation is unknown. And it's a loan, essentially. It's a loan agreement where the loan converts to equity at some point in the future, normally when you do your next round. So a very common way to do it in Australia is the pre-seed round, which is like the first round, sort of like the friends and family round is a note.
Friends, family and fools, yeah.
Good point, good point. That's quite often done as a note. You don't have to.
So it's a loan. It's a loan. And
but it never gets paid back, so it's a bit of a trick.
It's a donation. It's a donation.
It's a very, very high risk loan.
Yeah.
Basically, it's the highest risk loan that exists. And what the common problem, in my opinion, with angel investing is that the investors want their money back when they invest it, and they put all these clauses in to make sure they get their money back. But that's not the objective of the investment. The objective of the investment is to see if they get to the next round. That's the only objective of an angel
Just get
investment.
to the next round.
I like you. I like that. I'm going to fund you to get to the next round. Now, I want a big return for that. I want 100% per annum return, which is fair, right? Because the risk is like out of control. But what normally happens is they factor in the 100% return, plus they put a hook in to get their money back at the earliest possible point, which is like super bad for the founder and the company, and it seriously constrains their ability to operate. And then when they go to the next round, the investors are like, oh, what's that? I'm not dealing with that.
The investors see that they've got to pay back the 100% on the $500,000 gift that was given from the angel investor.
Well, exactly.
And they go, wait a minute.
Exactly. They're never going to invest.
We're not here to pay that guy back.
Exactly.
Or girl.
And even if you need to negotiate with them,
the
investors will see it and go, red flag, not happening.
Right.
Every time. And it's a really big problem in Queensland, particularly when we have such a new angel community, and it's a big problem for Queensland startups, in my opinion, the terms that they can get themselves into early on. And there's innovation in this space, like to sort of balance out this point. So Matt Allen is starting like a revenue share like venture capital firm, and there's a couple of others out called Lighter Capital is another one, where you get the money up front and then you pay back a revenue share once your revenue kicks in. So the very, very early stage investors can get their capital back, but not necessarily using a loan structure. And it just seems to be, I guess it's a bit of an experiment to see if we can help the early stage investors get a return, but not get constrained with shitty terms that the later stage investors don't want to deal with. Because I guess, again, to balance it out, the risk in the beginning is out of control high. And angel investors don't want to just peg their money in the gutter.
No, fair enough.
So we need to balance it out somehow.
So there's the friends, family, fools. So that's called pre-seed.
Pre-seed-ish these days. I think it's being wrapped up into that. So that's normally convertible note. So
that's basically convertible note is a donation, a loan, a gift that I want 100% return on potentially. So I want you to pay back what I gave you plus that on top.
The main thing is that if I'm investing now, when you do your next round, I want to see that I've had 100% uptick. I don't really want my money back, although some of them might if they're using one of these lighter capital style revenue share things. But you don't normally get your money back. It's just that if I'm investing now, I want to know that I had 100% uptick. And you normally get, say, a 20 or 30% discount on the price of the next round, and you can get some interest as well.
Okay. So the next round is the seed round?
Seed round, yep.
Yeah,
it's normally a priced round. So it's normally the company selling equity, creating new equity at a certain share price. So you can't really get away with a seed round in Australia too often without setting an actual price. And it's important, because to set a price for your company normally requires quite a professional and sophisticated investor. And it's called the lead investor. Very hard to get in Australia. Normally, it's easier to have 10 investors that say, I'll invest if someone else invests, which is super painful for most founders. I shouldn't laugh. I laugh in pain because I've been through this.
Yeah.
And fortunately had a really good guy help me with my seed round, Richard Moore out of Brizzy, one of the more prominent Brisbane Angels, and he's now on my board, which is cool. It's great to have people like that around your company. He helped me with that lead investor thing. And
most investors do like to be on the board, don't they?
normally, for a proper seed round, say 500K or more, they'll normally want a board seat. Not always, of course. You can sometimes even get a venture deal done without a board seat, but the board seat's there just to protect the investor money. You need to be careful as a founder what terms you accept. But I would normally recommend people read the Airtree open source term sheet. Essentially, the terms in that term sheet, I believe, should be, plus or minus 20% implemented as the standard seed Series A terms for Australia. One of the big problems we have in Australia is everybody wants a different deal in every situation, and at the end of the day, it makes no difference. Makes no difference. We just need lots of companies funded. We need them to fail fast, and so the good ones survive, and we have a thriving innovation community. What unfortunately we see now is deals take a really, really, really long time with everybody negotiating over every little term, and then everybody wants to be involved. We see this at Cake all the time. Like, we've got this perfectly good agreement that's like the industry standard, and then all the directors and founders want to go, and all their advisors want to go, and then the team want to have a say, and then like 4 months later they haven't even got a document in place.
Yep.
Well, how costly is that? Anyway,
so we're that's right. I'm trying to keep to time. So seed round.
Yep.
Up to 10 investors.
About that.
We've got evaluation held in Cake. It's all in the documentation in Cake.
Yep.
And really easy to access. So I've spoken to 10 times that to actually 10 times that.
Exactly.
So potentially 1,000 people I've spoken to just to get those 10.
Roughly,
Sorry, 100.
Roughly, I reckon if you've got about 100 in your email list, you might have 30 meetings or something, 30, 40 meetings, and you get your 10 investors or something like that.
Yeah.
So that means you have to send, a couple of hundred emails in the first instance, and then 50 or 60 follow-up emails.
So Cake helps me send all of those emails?
Yeah, so as soon as you've had your meeting, you put the name and email address in of the investor, and you ping them an email, and they can log in, see the documents, they can invest directly through the platform, they can sign the actual subscription form right there and then with the amount that they intend to invest. So the ability to close your round is massively enhanced, plus just the time saving for the founder is out of control. So it's a big upgrade on the manual systems.
Excellent.
Yeah.
So I invested in Outland Denim.
Yep.
And went through the virtual crowdfunding.
With virtual, I think.
Yeah. And that was really easy. All that was, communication, obviously, all around, hey, this is high risk.
Yep.
Don't do this if you're not prepared to lose money kind of scenario. I think everybody says the same thing on that platform. I think they educate people really well around. Around.
They're the industry leader in Australia. Virtual. We're really closely aligned with those guys.
Yeah, and that's right, because then I just flicked over to Cake to finalize my investment, sign all the documents, and now I can log into Cake and I can actually see what my investment's doing.
Totally. So, I probably shouldn't say exactly how many shareholders Virtual has now, but, like off the back of a big crowd fund like that, it's a huge number of shareholders. So on the Outland Denim side, they love Cake because they can just upload this huge investor list and then start communicating with everybody really well from day one. Companies need happy investors, and then you get an email and you can log in and see what you own. You can see the key documents. They can, keep you updated with all their announcements on that platform. So on the company side, they're happy. They've got a huge efficiency upgrade and happy investors. And on the investor side, they're really happy because they can easily see what they own. And this is this will perpetuate more investment, right? Because if you had have invested and then not really received anything, and then you couldn't go and see, and then Outland Denim couldn't communicate with you, and then imagine the next update from them is, hey, fantastic, the value of your shareholding's gone up like 50% or whatever. That's kind of what you want with these high growth things. Then you're much more likely to invest again, in my opinion. I don't know. What do you think?
Absolutely.
Yeah.
Absolutely. So I think Outland Denim said openly, James Bartle was on our podcast, and he said openly that, he's got thousands of investors now.
Yeah, it's a lot. He's the top. He's got the most.
He's got the most.
He broke the record at the time, and it's been broken, I think, once or twice since. But we've got all those companies on Cake.
Yeah,
it's sick. We just love all those innovative, because the ones that go through these crowd funds, they're the coolest companies. You know, they're the people that the crowd care about. So it's so.
That's
awesome
right.
to
So
see.
it's actually, you know, proof as well. You know, it's social proof. It's market fit, product market fit as well, which is it's fantastic to know that people are prepared to back you in that way.
I think it's awesome. Yeah, big part of the future.
Yeah.
Of finance in Australia, I reckon, where you can back the things you care about and have a stake and then get involved. Modern business, they talk about a lot about community and brand, and people want to know what they're buying and where they're buying from. And so I think crowdfunding is lending on that sort of trend, and employee share schemes, again, lending on that trend. Build a community around your business. Make sure your team and even your customers and your suppliers, you know, anybody who's loyal to your brand, they can now, you know, have a piece of ownership in your company through either employee share schemes or crowdfunding. And I think it's just a great trend, and I think it'll continue to grow.
Yeah, fantastic. So what is Cake's purpose then?
So our purpose is to take equity, which sounds pretty boring, and turn it from like a rock into, you know, like a currency. So it's so hard to raise capital for private companies, and it stops people doing it.
It's just making equity raising easy, right?
We just make it easy. We just need
and it's
more
peace
great
of mind.
companies to be funded, so they can grow and build these amazing businesses of the future that we need. Otherwise, we're just going to have, you know, all these oligopoly businesses just doing whatever the hell they want without any competition. So we think it's, you know, it's really amazing to help these companies get funded.
Yeah, I mean, for example, you know, there's businesses out there that we may never need to purchase from, but essentially they're doing such good in the world that why wouldn't we want to back them? And we can see the potential for their growth. We might understand their purpose and the problem they're solving maybe slightly earlier than the next person. Hence, absolutely, I want to invest in them. So I guess what I'm understanding is that for business owners to you know, increase their capital raising potential, grow a little bit faster, because organic growth is super hard. Doing it off the back of revenue is super hard.
Especially when in the beginning, when you don't know what you're doing.
Oh, mate, just anytime.
Well, anytime, exactly. But in a startup, you normally don't know who your customer is or what you're selling them or how to sell it to them or any of that stuff.
But there's the peaks and troughs of business. You know, when you're at 7 people, you know, you could be going absolutely awesome. Then there's a trough until you get to 12. And Daniel Priestley, author of Key Person of Influence, says, you know, do not hire the 13th person unless you're prepared to go through, a desert to get to the 40th person when you are actually like basically bridge the gap to the next phase of revenue and profitability.
I love that. We just did that. We had to change everything in the last 6 months in the company to go from what we were to what we wanted to be. And it's hectic.
So a cap raise in that moment could actually be really handy.
You want to do it before,
Yes, I mean, obviously.
So we raise capital, and then you go through, and you got to hit the milestones on the other side. Otherwise, then you have like down round.
True.
Not so good.
No. Right.
Down round is when the round after is at a lower valuation to the round prior.
Oh, no, thanks.
Not fun.
Yeah.
Can be done.
Yeah.
But avoid.
Yeah. Okay. Jason, thank you so much for your time. I think we are going to wrap it up. But what would you say, I guess, the best course of action is for people that listen to this and still went WTF? Like, and went, okay, I need to understand more about this. You said you do a bit of education. How do you do that, and where do you do that?
Yeah, so we've got a blog, cakeequity.com. Hit the blog. There's a ton of great resources there. We try and simplify everything, so most of them are just 4 or 5 minute reads. There's a couple of bigger ebooks, so you can sink your teeth into those. They're very practical as well. There's some checklists. And then, look, if you do want to raise capital, just get on Cake. It's so affordable. We've tried to make price like not an issue at all. It's just a simple monthly fee. And it's actually free for the first 5 investors. So if you're just starting out, get on there. You can literally raise capital and do an ESOP for free, which is
ESOP.
pretty hectic.
What's
Employee share option plan. So you can start giving shares to your team for free, right? Which is pretty wild. Would recommend you probably get some legal advice with that, but you don't have to. But
do you have links to those people?
Yeah, so we sort of coordinate everything for you. So sign up for free, have your onboarding session. We've sort of packaged everything up so it's like fixed fee and as small a cost as possible. So we just want people to be able to use these amazing tools, get funded, and then once they're growing, then they can potentially continue to professionalize things and pay for things a bit more.
And so I've registered for the platform. I'm on there. I'm using it. I'm going, this is really cool. I know some stuff I didn't know before. Where do they say I need help? And who are they reaching out to? Are they reaching out to you or your partners?
Yeah, directly come to us. So there's a chat feature in the software. There's a chat feature on the website. It comes straight. Sometimes it'll come straight to me. Like if you ring Cake right now, I'm pretty sure I'll answer the phone. So
not right now.
Don't do that.
We're on a podcast.
Not too many people. No, kidding. But no, just give us a call. Hit us on the chat. We'll point you in the right direction. We can definitely solve most things around capital raising and employee shares in Australia.
Great.
And normally in a matter of 5 or 10 minutes, we can demystify like heaps of stuff. And it's incredible how we can unblock you if you just ask a couple of questions.
Fantastic. Thanks so much, Jason. I think that's great peace of mind for you guys out there, founders, CEOs who are looking to raise capital or do those ESOPs, employee share option plans.
Nice.
Whoa. Woo.
Quick learner.
And look, get on the platform. It's free up to 5 people, 5 investors, which could be your employees. And why not?
Why not?
You could learn something. I might get on there myself. I might learn something. Thanks, guys. You've been watching the Proactive Podcast. I'm Chris Hogan from Me Media. This is Jason Atkins from cakeequity.com. Check him out. Thanks for watching.
Thanks, Chris.